Thank you, Nikki. Hey everyone, how's everybody doing? It's so good to be with you again this year. But who is joining us for the very first time this year? That's amazing. Welcome, because we're so glad that you're here. And whether it's your very first time or you've been with us before, I do want to say this: showing up matters. Investing your time in your professional growth is a way to celebrate this day. So round of applause for you. Thank you for showing up. Now, like every good journey that we take, the more road that we cover, the more confident we become. And I'm talking about journeys. So I want to ask you this: who took a journey to Las Vegas? Who took a road trip? That's awesome. Those that didn't take the road trip, have you ever taken a road trip before? Yeah, we've taken several road trips. I will tell you this: at a very young age, I would take a road trip where we would start off in Chicago, and our destination was San Luis Potosí, Mexico. That's a 32-hour road trip. Sounds fun, right? And you know what? We traveled in this. Some say that's vintage nowadays, right? Back then, there was no AC, and the closest that I ever got to experience an overnight stay was at a rest area. We did this every summer for 8 years. But you know what? At a very young age, what I started to notice are patterns on the road. I knew where the next gas station would be, where the next rest area would be, because I knew the route. I had the experience now, and I felt very confident that one day I could lead that road trip. I haven't yet though, but I was feeling very confident at a young age. Because I will tell you that at a young age, I thought I knew what it took to prepare for such a long road trip. And guess what? That's what we're going to do today. We're going to go on a road trip from Schedule C to the S-Corp, to the 1120S. Now, some of you have been thinking about taking this road trip, this type of journey with your client. However, as we know, when we plan for a trip, it's very important to plan ahead, watch out and not take that wrong exit, and make sure that we stay aware of those caution signs along the way. So today, our road trip, I'm going to be your guide, I'm going to be your GPS, you're the driver, and in the passenger seat, that's your client, the self-employed entrepreneur. Are you ready? Let's do this. First, let's start off with knowing the road. What is an S corporation? An S corporation elects. There's an election. They elect to pass through their income, deductions, credits, losses to the sole shareholder. They retain those pass-through tax benefits because there is no tax that gets paid up at the S-Corp level. And they also retain that protection, that legal protection of the assets. Like I said, that entity is not taxed up there at the corporate level. Instead, the shareholders are the ones who report that net income on their 1040. But before we take a road trip, we need to know who is in this passenger seat, right? Let's really get to know each other with this passenger. Because this passenger, they're the business owner. They have to first be an LLC or a corporation. DBAs, they're not allowed on this road trip yet. We need to make sure that they're an LLC or a corporation. Also, before they're even allowed in our car, this LLC, this corporation, has to be a domestic corporation. They formed those articles of incorporation, those LLC documents in the US. And the allowable shareholders that are allowed in our vehicle, they have to be US citizens or US resident aliens. And our vehicle only fits 100 people, 100 shareholders. That's the max number of shareholders that an S corporation has. And they can only have one class of stock. And I'm going to talk a little bit about what that means. But before we close that suitcase, let's talk about the allowable shareholders, the US citizen and US resident. Because many of us run into taxpayers with an ITIN. So before you close that suitcase, let's talk about this. In the Internal Revenue Code, we do have a law, section 7701, that has a substantial presence test. And there's several tests that get met for an individual that is in the US for more than 31 days and they generate income. Congratulations, you are a resident, but only for tax purposes, because that is a legal way for Congress to collect tax on those individuals that are in the US. They're a resident only for tax purposes. Tax law is very different from immigration law, very different from employment law. So ITINs, we know the purpose of ITINs. They're a number, right? They're an ID for that taxpayer to pay the tax, to file a tax return. That ITIN, we know very well, does not authorize that taxpayer for employment. So I will tell you this GPS will not go further along the road if the taxpayer has an ITIN. And we have to think about this. What is the purpose of us being on that road to an S-Corp? It's to reduce that self-employment tax, right? Reduce the tax for our clients. But there's other ways that we can help them reduce tax, because the road to an S-Corp is not the only strategy that we can have for these clients that have an ITIN. There's other ways that doesn't have to involve an S-Corp to reduce the tax. Now, when we talk about eligibility, one class of stock, what does that even mean for an LLC or a corporation? The most important thing that you need to know about this is that if you have more than 2 shareholders, the distributions have to be treated equally. When a taxpayer is a Schedule C, they're very used to digging into that business bank account whenever they want. And we don't really care. They're a Schedule C. They get taxed on the profit. However, when they're an S-Corp, we have to be more careful, especially if there's more than 2 shareholders. Because when one shareholder takes money out, the other one must also take money out according to their ownership percentage. This example, 2 shareholders, 50-50 owners. Luis takes a distribution of $100 out of the bank account. Guess what? Maria, the other shareholder, you got to go to the bank and take $100 out too. Because if not, that destroys that one class of stock. And then the S-Corp is no longer eligible to be an S-Corp. So now that we said, okay, we have vetted our passenger. They're a domestic corporation. They're either a US resident or US citizen. There's only less than 100 people in our car, and they have only one class of stock. We're ready to start the engine. Anybody recognize this picture? It's what we have to pay, right? To keep going on this road, we have to pay the toll. So let's talk about, we came across our very first toll right here. IRC Section 351 exchange. Now what this is that when the LLC elects to be an S corporation, it's treated as if there is an exchange of the assets and the liabilities of that LLC in exchange for stock in the S corporation. Okay, so let's look at assets and liabilities on the balance sheet. What about if the assets are greater than the liabilities? There's more money in that bank account than what is owed on credit card statements or on a loan. Then we're good. There's no gain. That's the basis of our stock in the S corporation. And basis is very important to keep track of year after year. And I'll let you know why later on. What about if this business owes more money than what it has in the bank, more than the assets it has? We have a taxable gain when we elect to be an S corporation. And that is according to Section 351. Because again, we're talking about basis. What is the basis in the stock of the S corporation? Basis, if you learn nothing today, learn this. Basis can never be negative. Instead, we have to declare and recognize that gain on our tax return. So should we continue on this road if we have a client where they owe more money than what the business has in the bank account or the assets that it owns? We have options. Taxpayer, before we elect to be an S corporation, put more money in the bank or pay off your debts, or recognize a taxable gain. Pay that taxable gain today and we can continue on this road. What about appreciating assets? If that LLC, if that corporation, that business owns appreciating assets, what's a really good example of an appreciating asset? Real estate. If it owns real estate, we run into problems because here's another toll that we have to pay. S corporations, there is no step-up in basis. Now, what does this mean? If the taxpayer owns a home that they're renting out, they're in the business of renting out, they become an S corporation, guess what? The amount that they paid for that home gets transferred over to the S corporation. Okay, so far we're good. But what about if that client decides to retire? They no longer want to be in the business of renting, and they're going to change that deed, the title of that home, over to them personally because they're done. They want to retire. Well, guess what happens? It's considered a taxable transaction. That asset, in order for it to change ownership from S corporation to the shareholder personally, it's considered as a taxable event. It's considered as if the S corporation sold that property at the fair market value of that day. And we know it's appreciating. Real estate appreciates. So even if there was never a sales contract, there is never a dollar exchange between the shareholder and the S corporation, we have to pay some taxable gain. There is no step up in basis. There is in partnerships. So if you do have clients that own real estate, S corporation is not the way we want to go. Instead, we want to go maybe the partnership route. Here's another toll that we come across: the administrative responsibilities and the cost to run an S corporation. We have our professional fees because we will be charging for that extra return. We will be charging for payroll reports if that's what we're going to be handling. Bookkeeping and accounting services. If that Schedule C client has not been good about keeping books, well, guess what? When they're an S corporation, it's really important to keep track of our books. So either they're going to take care of it or they're going to pay somebody to take care of those books. And like I said, payroll costs. You have all those forms, 941, 940, W-2, W-3. There's a lot going on with an S corporation. We're going to talk about comparing what a Schedule C and an 1120S looks like. We're very familiar with it with the Schedule C, right? The net profit, 100% subject to self-employment tax. And here I'm just putting an example of what the tax prep fee could be. Then we look at an 1120S. Under the same scenario, same income, but now we have salary out to the shareholder. So our net profit is less. Okay. And the amount of payroll tax is only subject on that shareholder salary. The tax prep fee, we're still going to charge to prepare their 1040, and we're going to charge at least $1,500, right? The industry is charging at least $1,500 for an 1120S. And then we have the payroll return fees. If we're going to handle payroll, we're going to be charging a fee for that. If we compare them side by side, we see that there is a savings of about $2,200 in this example. The banner is covering this, but you'll see this in your presentation. There's a link at the bottom of this slide that gives you a calculator that we created at Intuit, where you can enter your Schedule C net income, and we run the numbers for you and tell you how much the savings would be, if any, if they become an S corporation. So it's a good resource to check that out before you elect to become an S corporation. So at this point, should we continue with the $2,200 of a tax saving for this example? Well, it all depends. Our taxpayer, do we see them growing in profit? Because yes, maybe $2,200 of a tax savings today could be $10,000 of a savings down the road if that income keeps growing. Our clients' goals, do they have a desire for long-term growth and planning flexibility? Are they going to listen to us? Because we're going to be on them about having those books in order. We came to our very first exit, exit 315 to Interstate 2553. This is our form, 2553. This is how we say we are electing formally to become an S corporation. This form has to get filed with the IRS, and it's about 4 pages long. Not every page is required, depending on the type of election that we're making or the type of corporation that we are. But the very top of this form, you see it's the basic information of the taxpayer: their name, their address, the EIN. This form, first, before we file the form 2553, we need to make sure that the entity is eligible. Remember, we talked about that. They have to be a domestic corporation. The shareholders must be a U.S. resident or citizen, less than 100 shareholders, and only one class of stock. All shareholders must sign this consent, must sign the 2553, and it has to be a wet signature. Digital signatures are not allowed. So please make sure that you get a wet signature on this election. Now, when do you have to file this election? Well, it depends. When does the taxpayer want to start becoming an S corporation and be treated like an S corporation? Because of that day, we have 3 months and 15 days to file the 2553. An example. If the client wants to be an S corporation for this year, 2025, we had until when? March 15 of this year to file the 2553. So we have 3 months and 15 days. Well, what about if it's a completely new business that formed its LLC, filed its paperwork with the state today? But we still want to be an S corporation as of today, the new day that the entity became an LLC or a corporation. Well, that's when the time starts. We have 3 months and 15 days from today to file that 2553. What about if we missed the exit, March 15? We can still do a late election because they will allow us to make a late election up to 3 years and 75 days after we intended to be an S corporation. But we do need to have a reasonable cause. But I will tell you this, the IRS is very lenient on what they mean by reasonable cause. They're not as lenient when we try to ask for forgiveness of penalties, but they're very lenient on reasonable cause for a late S corporation election. And we need to know what that reasonable cause is, because we have to notate that on Form 2553 when we file that late election. Why were we late? Reasonable cause, an example, there was a miscommunication. But this taxpayer intended to be an S corporation from January 1st of 2025. They've been paying themselves a salary. They were running as an S corporation, and there was just a miscommunication. There was no awareness that a 2553 had to be filed. You just have to state something like that on the 2553. You do have to also include, you see that on bullet point number 2, that text at the very top of the Form 2553. Filed pursuant to Revenue Procedure 2013-30. Now, if you're filing this form, the 2553 late, with the 1120S, with the S Corporation return, make sure that on page 1 of that 1120S, you're also writing that text above, which is on bullet point number 3. Includes late election filed pursuant to Revenue Procedure 2013-30. That's the revenue procedure that allows us a late election. What about if we're taking this road trip and we go through one of these states? Community property states. When it comes to an election of the Form 2553, the S Corporation election, and if you're in one of these states, guess what? The spouse has to also sign that form. Even though if the spouse is not an owner of the LLC, has nothing to do with this LLC, the spouse must still be included on the 2553, and right next to her name or his name, you do have to enter the words consenting spouse. But you will notate that they own 0 shares of that S Corporation. And that spouse must sign that election as well. Because we have the Internal Revenue Code Treasury Regulation and also the instructions of Form 2553 that explicitly say this, that if the spouse is not signing that 2553, our S Corporation election can be terminated. So we've come across some caution signs, some compliance requirements when we have an S Corporation. The first one, very much known, reasonable salary. It is a requirement that if the shareholder is providing services to the S Corporation, they must pay themselves a reasonable salary. And what is reasonable salary? The tax code does not help us at all to determine this amount. There's no special formula to find out what that number is, what the magic number is, but I will tell you this, if it's too low or it's 0, there's a red flag. The IRS is not like that because you stopped paying self-employment tax that you used to pay as a Schedule C, and now you're an S Corporation. Where are they getting their money from now? Especially if you're not paying any salary. I will tell you this, I don't know if anybody has filed an S Corporation election lately, the Form 2553, I just did in March. We got the confirmation letter that congratulations, you're an S Corporation. This is the first time I noticed that there's a paragraph included in there saying, from now on, you have to pay yourself a reasonable salary. I don't remember seeing that last year on the acceptance form. So reasonable salary, how do we determine that? Well, first of all, we're not going to determine it. We might help our client determine it, but it's more about having them figure that amount out. There is a software, RC Reports, that does charge to help you print this beautiful report based on location, based on duties, and it's a questionnaire that the client is going to answer. And that's going to come up with a number. Now, that's nice proof if you ever get audited that this is how we determine reasonable salary. Now, if you don't go that route, then we ask the client, what all do you do for your S Corporation? Not only are you doing whatever the business is doing in the line of business, but you're also probably managing the employees. Maybe you're running the accounting, doing the books. How much would you pay yourself? Would you pay somebody else to do the exact same duties that you are doing? And that's the number that we will use. I will make my notes on how the client determined that amount so that we have the record on file. I did want to mention, you can't see it at the very bottom, but what's the risk of having very low salary or no salary? Is that the IRS can come back and reclassify all of those distributions All of that money that the shareholder was taking out of the bank account for the business, they're going to reclassify that as salary. And they're going to hit you with payroll tax and penalties and interest. So it's not a good thing to not have any salary. We need to have an amount there. And we need to make sure that it's not unreasonable, where it's $12,000 a year. What about fringe benefits? The most common example of a fringe benefit is the health insurance. When you're an S corporation, the S corporation can pay for that health insurance. They'll take a deduction, but guess what? That amount of the health insurance that was paid for that shareholder that is an owner of more than 2% has to be included on box 1 of the W-2. It doesn't get included on box 3 or 5. It's not subject to FICA, to Social Security and Medicare tax, but it is subject to box 1, federal income tax. But then the client, the shareholder, can take a deduction on their 1040 as self-employed health insurance. So it's really just the way of reporting. The S-Corp can take the expense, but somebody's going to have to pick up that income, and that's going to be the shareholder. Then again, they take the expense as a self-employed health insurance deduction. Now, another common example of fringe benefits is group term life insurance. It's not allowed at all for shareholders. Cafeteria plans. You're not allowed as a shareholder to be in a cafeteria plan. A cafeteria plan, the most common example under there, dependent care expenses. Shareholders that own more than 2% can invalidate that whole cafeteria plan for the company. Another compliance requirement that we have, an accountable plan. And I think this is a really big adjustment for their Schedule C clients, because when they're a Schedule C, they're using their personal car for the business. So they're keeping track of those business miles, and we include those business miles on the Schedule C as a deduction. Maybe they're using their home office. So we're filing Form 8829 and taking that home office deduction on Schedule C. Well, now that they're an S corporation, is the S corporation the owner of that personal residence? Probably not, right? How about the owner of that vehicle? Probably not. So how can we take a deduction? We can use an accountable plan. But we do have very strict rules by the IRS, because the benefit of the accountable plan is that the S corporation can take those type of expenses, reimburse the shareholder for those expenses, and the shareholder doesn't have to pay income tax on that income that is coming through. It's just a reimbursement. But in order for us to follow these rules, we need to be familiar. Here we have the 30-60-120 rule. If the S corporation is giving cash, money to the shareholder, maybe they're taking a business trip and they're giving them cash, here, spend this money for your business expenses. It's not very common because we do use a lot more credit cards. But if there was ever cash given for some type of expense, the shareholder has 60 days to fill out an accountable plan reimbursement. They have to keep a log, have the receipt, state the purpose, sign it, and give it to the S corporation, even though we're talking about the same individual, but it has to get done this way. Give it formally to the S corporation, keep it on record. The S corporation writes them a check to reimburse them for anything. But if there was any expenses that did not hit that limit, maybe they did give them cash and there was money left over, we have 120 days to give that money back, deposit that money back into the S corporation business account. Because then if we don't, it's taxable income to the shareholder. So if we don't use cash, but we're using the business vehicle and we're using the home office, we make sure that we still file for our records the Form 8829 to compute the percentage of the expenses that is the home office, and also the business miles. Keep a record of those business miles. It's 70 cents this year. We're going to reimburse it. We fill out the shareholder, we're giving this responsibility to the shareholder. fill out that accountable plan, and turn it in. I have a standard amount about 45 days. So yes, we better be charging minimum $1,500 or more for taking care of an S corporation. The other compliance requirement that we do have, and it's very important, and I think it's missed a lot, is basis tracking. We talked about at the beginning that when we become an S corporation, we have a value for those shares that we received from the S corporation. And what is that value? The assets minus the liability. Then every year, we need to track the value of that basis. The income that we see on the K-1 from the S corporation will increase the value of the basis. Any losses that come through will decrease. And what about distributions? Where the shareholders taking money out of the bank account? That's going to reduce basis. And why is it so important for us to keep track of basis for the shareholder in this S corporation? One, what about if that business did not do good that year and they generated a loss? Well, guess what? That loss is limited up to the value of that basis. So if that basis is 0, we cannot take any of that loss that year that comes through to us on the K-1. Instead, it gets suspended and it gets carried forward to future years until we have some basis in stock. Another point for basis tracking is the taxability of those distributions. They keep taking money out of that business account. Is it taxable? The only way that we'll know if that's taxable or not is by the amount of basis. What is the amount of basis in that stock of the S corporation? And then we also have a stock sale impact. One day, the taxpayer might decide to retire and sell the business. How are we going to compute the sale, the gain or the loss on the sale of that business? We need to know the basis. If you haven't started tracking basis, we need to go back, ask for tax returns, look at bank statements, have there been any distributions out, and start tracking basis. Of course, this is a service that we are going to charge for, but basis must be tracked, and that's something that we need to talk to our clients about, how important it is to track basis, because it can cause a taxable event where they would have to pay taxes if they don't know what the basis value is. We have reached our destination. The road from Schedule C to an 1120S is not just about filing a Form 2553 or the Form 1120S. It's about having a vision. It's about leadership. It's about knowing that road before you even start the engine. So if your client comes to you and says, I want to be an S corporation because I heard it on social media that it has a lot of great tax savings, remember this: you are the driver, not the passenger. Thank you. So I have a tradition, if this is your very first time with us, is I record a video of the audience and we're going to do a little dancing, if that's okay with you. Can I ask you to please stand up? We're going to have somebody play music for us, and I'm going to record this for our social media. Did I leave my phone? Oh, thank you. I think I left my phone. Yeah. Come on, we got a good stretch. We're almost done with the day. This is going to bring us some energy. As soon as the music comes up. You guys ready? We're waiting on the music. Thank you, everyone. Oh, you guys want to continue dancing? I love this group. We are going to leave it open for questions. We have enough time for questions because I know S-Corporation is a very hot topic. So bring your questions. If there's anything I can help you answer.
There are microphones
Yes.
all the way back, so be sure to go to the microphone for your question.
Yeah, if I can hear you.
You say you work for Intuit?
I do work for Intuit.
Do you connect, is there a calculator with Intuit when you use Pro Series or anything like that?
There is no calculator. Instead, what it is, it's a link to our website with Intuit. They're asking if it links to Pro Series or to any of our products, that calculator that can compute the estimated tax savings when you convert from a Schedule C to an 1120S. It doesn't connect to our products. Instead, it's just a website that we created with a calculator that you can enter the net income for the Schedule C, and we can walk you through the QBI deduction and the S-Corporation savings. Yes.
Question on compensation to the shareholders.
Uh-huh.
How does that differ from salary that goes on W-2? Is that too different?
It's the same. No, it's the same. Salary, compensation, it's the same wording. A W-2 is what the shareholder needs to start receiving.
Okay, so then on the 1120S,
Yes.
the first line says shareholders compensation.
Yes.
W-2s. We just take the difference of the two.
Okay, so the line that specifically says compensation for officers, that is where you're going to enter the amount of the W-2 of the shareholder. Every other employee in the business goes on the separate line, and that's what would generate an audit if that amount is zero for compensation for officers. Yeah, thank you.
Question over here.
Hi, Nadia Rodriguez. How are you?
Hey, good.
It's been a while.
Yes.
Two questions.
Yes.
So you mentioned earlier in the presentation that if you had two or more like a multi-LLC, the best
Shareholder,
thing is
yeah.
for 1065 for that to avoid the 1120S, because I do have clients that do both. And so the base is obviously on the 1120S for two members. But for the most part, I've been doing 1065.
Yeah.
Is that something that
No, and that's fine. It's always the goal of what we want with the partnership versus the S-Corporation. So with the partnership, we have a lot of flexibility on distributions. One partner can take out $10, doesn't mean the other partner has to as well. S-Corporation, it has to be very strict on those distributions. They have to be equal according to their ownership.
And that was good knowledge because I did not know.
Yes, that can terminate. That I do see that missed a lot, especially when you have two shareholders and one of them brings to the table a lot of money and the other one just brings in their services. The one that brings in a lot of capital feels very entitled to just go in and dig out some money. If that happens, this one has to as well. If not, it terminates the S-Corporation election.
Based on percentages, correct?
Percentages, correct. If it's a 60-40, 60% has to be taken out, 40% of that has to be taken out.
Now, as far as compensation for husband and wife, there's
Yeah.
a lot of husband and wives that have the LLC that we really want to deal with this when we ask,
Uh-huh.
right?
Yes.
So taking about compensation, doing the W-2s for them,
Uh-huh.
because they do the bookkeeping as well.
Yes.
So trying to determine that salary
Yes.
for husband and wife. For the most part, no offense, husbands, but for the most part, women, wives get more percentage, as I do.
Yeah.
More percentage
Yes.
of our business. So I base it on who does what and
Correct.
within the business.
Yes.
Along with their there's a personal budget.
Yes.
That's something that I also am doing for
Yeah.
my client.
Uh-huh.
So I do the personal budget. How much do they have in da-da-da?
Correct.
expense bills, take that, multiply it by 12. So that's how I'm basing it for husband and wife. Is that something that I can continue?
Yeah, and that's the perfect scenario because, yes, if you have more than two shareholders and you do notice that one of them is putting in a lot more work, their W-2 has to be greater than the other one. And so yes, and you know, you're looking at your shareholders' living expenses. How much money do they need to live comfortably?
Correct.
And you come up with that budget, that number. Is that too low? You kind of have to have that gut feeling. If it's not, then let's do it. And if they need more money than what they're receiving in salary, then yeah, they can take a distribution out of the bank account. Remember, track basis to find out if that distribution will be taxable or not.
And what about, let's just say, we're looking at, I always think about S-Corp, like a corporation, you think about yourself like Chase or Walmart.
Uh-huh.
Right? That's how you usually do your business. That's
Yeah.
how I educate
Uh-huh.
our end. So what happens if they decide, you know, we want to get a bonus at the end of the last quarter? That's something that they can definitely do and add that to their W-2.
To the W-2, yes.
Put it in separately as a bonus.
Oh, for sure, for sure. I would tell you the IRS will not complain if you increase that salary and bonus and everything because you're paying that payroll tax.
Correct. So the payroll tax.
Yes.
Okay.
Yes.
Well, thank you so much.
Yeah.
I really appreciate a lot of your knowledge, a lot of your information that you've given us throughout the years have really expanded our Latino Tax Fest. Thank you so much.
Thank you. Thank you so much.
I have a question from online.
Okay.
It says, how do you recreate basis if a client comes in without that information?
We ask for prior year returns and we ask for bank statements. If they don't have that, we're going to do our best to try to have them answer the question of how much money do you think, you know, we're going to do our best that we can with what we have. But yes, start asking for those prior year returns.
Yeah, we have some shareholders who are not officers,
Okay.
but those should not be listed on the officer compensation.
That's a great question. And you know what I do? And when we're talking about officers, when you have an LLC, you give the official title of an officer, right, to some shareholders. I include all the W-2s from all the shareholders on that line, compensation to officers, just because I want to separate the wages from those that are non-shareholders. So I do include all of that in that line.
Thank you.
Yeah, you're very welcome. We
Another
have,
question online.
yes.
Would a promissory note create basis?
No. And so that's another excellent question, a way to take money out of that bank account because maybe the shareholder is in need of money. That salary that they're paying themselves maybe was not enough for the month. They can't take money out because maybe their basis is zero. Then let's create a promissory note where this S corporation lends money to the shareholder. But we do need to have a legitimate promissory note on file where we're charging an interest rate. We have the terms of when that loan will be paid off. We cannot just take it out and not charge interest because then it can be classified as either a taxable distribution or some salary.
What's the best way to keep track of the basis? Like when you're starting to, the company?
Follow Form 7203. 7203 has a pretty good roadmap where it tells you what the beginning basis, you start off with the beginning basis. On day one, it's going to be your assets minus your liabilities. And then every year, go down that route. Okay, the income, and it'll tell you exactly how to increase or decrease basis.
When you mentioned retirement, let's say you just close the door and you don't want to sell everything.
Yeah.
How do you handle that?
How do you get the assets out of the S-Corp's name, right? You have a business account maybe that has the S-Corp. Do you have any other assets? Usually if it's a service industry business, there's not many equipment, machinery. It's probably just a bank cash account. Basis. Whatever is in that bank account, if you take it out, do you have enough basis to cover it? Or do you have zero basis and it's a taxable gain?
Do you report on Schedule D?
On Schedule D, yes. I think we're good. Nick, any other questions online?
This one here online, if the S-Corp is not generating income to pay the shareholder, what about payroll purposes?
Oh, excellent question, because we need to think about the S corporation needs to pay its business expenses. And probably the shareholder is the last one in line to receive a salary. If there's no more money to pay that shareholder anything for the month or for the week, there's no salary. But that shareholder better not take any money out of the bank account. Because what has to happen first is that salary has to be paid first, and then distributions can be taken out. We're good?
This one I'm
Oh.
not sure, but it,
Okay.
where'd they go? Oh, there. Can you elaborate on the need for shareholder, I'll say that. Can you elaborate on the need for shareholders to do symmetrical distribution?
Oh, yes. We were talking about those because what we don't want to terminate by accident the S corporation election. And we can do that by having disproportionate distributions per shareholder. And you run into this problem if you have 2 shareholders or more. When that distribution, that money is being taken out of the bank account, we need to make sure that every single shareholder takes the equivalent amount based on their proportional interest in the S corporation. So an example, if $1,000 is taken out of a bank account and we have a 60-40 ownership of 2 shareholders, one shareholder is only allowed to take $600 out, the other one has to take $400 out.
All right, any other questions?
No?
Excellent, thank you.
Thank you very much.
Now next is a 20-minute break. So you have until 3:10.
Okay.
And then come back 3:10. So go to the marketplace and buy stuff.
I got it. Good job, you killed it.